Return to our focus on alternative assets. As we've been reporting on money moves for a while, it's been a less than stellar year for hedge funds. The Bloomberg Hedge Fund Index shows year-to-date losses of almost 4%. So will they stage a comeback in 2012? Joining us now with an outlook is Jack McDonald. He is CEO of Conifer Group, which executes trades and handles administration for more than 150 hedge funds. Kelly Bitt, the lead writer for the Bloomberg Hedge Fund Brief, is also here with me as well. Jack, let's start with you. A lot of people blame volatility for the poor performance of hedge funds. Why aren't hedge funds better able to capitalize on the volatility than traditional fund managers?
Well, I wouldn't necessarily agree with that statement. I think volatility has certainly been tough, and that affects both traditional as well as alternative managers. There's also an extremely high degree of correlation, which has really plagued performance this year, where markets are moving very much in sync, and it's really been more about getting the global direction correct and doing that amidst the very volatile markets. All that said, I still think that there's a very compelling place for alternative managers. We tend to group them together in these indices, and there's a big difference between long-short equity manager performance this year, for example, versus global macro. But suffice to say, it's been a very, very challenging year, and you're correct about that.
Right, challenging year for all the different strategies. How has the record volatility that we have seen reset investor expectations?
Well, I happen to think that the investor expectations have actually very quietly softened a little bit since 2008. Not particularly a popular view, but I think that up until 2008, alternative managers really sung the hymn of absolute return, regardless of whether the market gyrations were up or down. And I think what we saw in 2008 was a very wide swath affecting all managers, whether absolute or relative return, and that there's a little bit of a relative return notion that has affected some of the institutional investors. And now I think people are being more cognizant of where the broader market movements are, where the volatility is, and have a place for alternative managers to be a part of a portfolio. And I still think the future is quite bright for alternative managers, and we're starting to see that, frankly, with the number of startup funds that we're speaking to that are actually starting to raise some money.
Hi, Jack. It's Kelly Bitt with Bloomberg News. I was just wondering what you've seen from hedge funds, what they're telling their investors in terms of appeasing them about how they've dealt with the volatility this year.
Well, there's a lot of commentary that we're seeing when our managers are reporting to their clients, and it's always placed within the context of what the broader market is. There tends to be a longer-term view, obviously strategy dependent, but managers are being very transparent in terms of what their global views are, and really a reaffirmation of the names that are in the portfolio, a real discipline around trying to not suffer from any style drift, and taking a longer-term view with their investors.
Jack, let's just get back to you with the fact that the Bloomberg Hedge Fund Index is down to almost 4% so far this year. What kind of level of redemptions are you seeing from investors? Are they bailing out more than they were, say, in years past?
I think it's a very good question. I actually am positively surprised by the lack of redemptions. There certainly in the last 2 months has been a fair amount of redemption activity, but given the performance in aggregate this year relative to some of the broader indices, I would have expected a deeper redemption level. And I think it tells you a couple of things. I think it tells you that there is a broader expectation, as I mentioned earlier, of when particularly institutional investors look at their asset allocation, that there is indeed a place for absolute return strategies, and that there's a longer term view and a more, I think, dedicated view towards funding managers. The quality of the managers is better, I think, than ever before in aggregate, and so the investors know that, and they're willing to make a longer-term commitment. I also rely upon the industry studies that continue to point to pent-up demand at the pension, the endowment, the foundation level for more alternatives within a portfolio. And so I think those overarching themes are actually affecting the lack of redemptions that we've seen relative to what some had feared could be a pretty tough year for redemption activity. And we should really know, because most funds would call for anywhere from a 30, 45, or 60-day notice period. And so year-end redemption figures are known, and certainly at Conifer we haven't seen that bad of a level whatsoever.
Okay, so that's what he says on redemptions. Kelly, you've also been tracking the closures of hedge funds, and there have been quite a few notable ones recently, right?
Yes, just in this past month, it's been Hunter Global closing, Talpian, and James Caird, and that's 3 examples just within this past month. we ran our data and we found that hedge fund liquidations for this year may end up at around like the 350 level. That kind of mirrors 2010. It's way below the 2008 level, which was at least 100 more. So not as bad as some people might think, but we're going to be keeping an eye on it because there's bound to be more through the end of this year and into next year.
Right, just a few more weeks for that. Jack, getting back to you, you say that you see a lot of parallels between now and 1997, and that was, of course, before the hedge fund industry really exploded. Does that mean there's more of a back to basics mentality when it comes to researching each fund and the big names running the funds?
Well, I think there's certainly a lot of parallels as it relates to the due diligence process that investors are going through now, and specifically looking, I view a recipe of success to include all the above, both a pedigree or a track record that people can point to. There has to be an operational infrastructure that can withstand institutional level due diligence, and you get into the details of counterparty risk, transparency for investors, et cetera. And I think what's new as opposed to 1997 is the real need to have day one capital, and whether that comes in the form of a seed deal or whether that comes in the form of some acceleration strategic day one investors. But people are starting not with $5 or $10 million as much anymore and really feel a need to get to 100 million. Kelly, I don't know what you see in your data, but certainly from our view of the world, we're seeing more startup activity. We're talking to a couple managers who have just inked $150 million seed deals, $50 million seed deals that are coming to the market with a better business plan in place. And my sense is that they're going to be successful over time.
Yeah, I think the 150 million level is kind of the basic seed deal from the big seeders like the Blackstones of the world, Goldman Sachs even, and that's pretty much a vote of confidence for institutional investors when those guys come and seed new funds, and the operational management can, kind of be up to par when there's that kind of level of assets. So I've been seeing that as well.
Gotcha. Jack, you had mentioned counterparty risk. That's a term we heard a lot in 2008. It's starting to come up again, what with the collapse of MF Global. Is that something that you're seeing a lot more of it to the extent that it's slowing down activities?
Well, I wouldn't say that it's slowing down activity as much as raising the same questions that we saw after the demise of Bear and Lehman, where managers all of a sudden understood in a more profound way hypothecation of assets and where your assets get custodied. It gave birth to everything from tri-party agreements to multi-prime relationships. And over the last 2 or 3 years, I've felt the need or desire for that dissipated somewhat. MF Global was a wake-up call again for people, and so we are seeing in the more operational side of the business more and more requests for people to have multiple prime brokers, to understand how securities are loaned out, to understand how cash is segregated and treated. And so both the managers are asking more questions today about who their counterparties are, and we're certainly seeing it from the institutional investors who come in to do due diligence.
All right, thank you so much. Jack McDonald, the CEO of Conifer Group, and also Kelly Bitt, the lead writer for the Bloomberg Hedge Fund Brief.